Welcome back, everyone. Today, I will be talking about the earnings of several key banks. So, in the past 2 days, we have had earnings for the biggest banks such as JP Morgan, Wells Fargo, Citigroup, Bank of America, and Goldman Sachs. I'll be talking whether or not there's an opportunity to buy some of these distressed stocks after the report of their earnings. So, let's get started. First, let's talk about one of the biggest banks in the world in JP Morgan. As we can see by the title of the CNBC article, JP Morgan did beat on both the top and bottom lines. JP Morgan boasted a 2.92 earnings per share with an expected of 223 per share, and they beat on the top line as they crushed revenue expectations with an expected $28.3 billion expected and a 29.94 billion in actual revenue. As you can see, their trading revenue and fixed income rates have gone through the roof with an expected of 4.53 and an actual of 4.6. And in the equity side, 1.67 was actual. And in reality, they got $2 billion in equity profits. So JP Morgan, very interesting company. It's actually my favorite company between these five financial institutions. I believe JP Morgan is the big dog. It's the biggest of the biggest banks. You can't get any better than this. In 2008, when the financial recession happened, JP Morgan had such a strong balance sheet that they bought up some of these dying financial banks, such as Bear Stearns, and Bank of America bought Merrill Lynch. So I like JP Morgan a lot personally. I do have some shares in JP Morgan. But as we continue on to the next bank, you will see my opinions on other banks and why JP Morgan is the only bank I own. The next financial institution on this list is Goldman Sachs. Goldman Sachs did crush their earnings just like JP Morgan. As we can see, they had an expected of $5.50 of earnings per share, but it was in actuality $9.68, which is an incredible beat of around 60 to 70%. They also beat on their top line. The revenue expected was 9.46, and they got around $10.78 billion of revenue. Just like JP Morgan, they did beat in fixed income assets and equity assets as well. Goldman Sachs is not your traditional bank. They're more into the investment side, like Morgan Stanley. That's why I say Goldman Sachs is less of a risk than other banks like Wells Fargo and Bank of America. I believe Goldman Sachs and Morgan Stanley are the only two financial institutions that are actually up in the entire year. Goldman Sachs is up around 3% and Morgan Stanley around 5. I really like this company a lot. However, I don't have a position in it because I believe that Goldman Sachs is slightly overvalued in especially to be in the financial sector. There's a lot of risks such as low interest rates, more retail trading, and more mutual fund trading. And I believe that Goldman Sachs is losing their edge. I believe that banking has topped out in 05, 06, and we won't see those levels ever again. Now let's talk about another bank. Next bank on this list is Bank of America. Bank of America is one of the biggest banks in the world. It is owned by famous investor Warren Buffett. He owns around 22% of Bank of America. He's a major shareholder for the past 20 plus years. So as we see in its earnings, their earnings were, in my opinion, pretty choppy. They didn't beat like JP Morgan did or Goldman Sachs did. The earnings per share were only 2 cents higher than expected. 51 cents per share was their actual earnings with the 49-cent estimate. In their revenue, they missed revenue, which I thought was quite interesting. Revenue expected was 20.8 and they got around 20.4. Their net interest margin, meaning their how much profit they got on that revenue, was also lower than expected. 1.7% was the actual, with 1.8 being expected. So Bank of America, I am not against Bank of America personally. However, I do believe that JP Morgan provides a better opportunity. If you're looking to get, the good stable dividend and growth opportunities, I think JP Morgan presents a more valuable opportunity. Their management, I don't think, is the best, and I believe there's better opportunities. But I'm not totally against this stock. like I said. But in terms of what they have, pretty bad moat, meaning that they don't have anything proprietary compared to other banks. J.P. Morgan and Goldman Sachs have been trying online software. For example, Goldman Sachs has Marcus, which is actually going to be one of the biggest online user platforms for like checking accounts and bank accounts and stuff like that. Now let's talk about the two stocks which I absolutely don't like. So the next stock I'll be talking about is Citigroup. Citigroup is again one of the biggest banks in the world. It was the biggest bank in the world, but has fallen off since 0506. They had an earnings of $1.40 per share, which was much better than their expected 93 cents per share. The revenue was in line. They beat by zero point 0.1 billion or 100 million. So a pretty flat top, but a pretty heavy beat on the bottom. They did have some scrutiny. They had to pay several fines, upwards of 500, $600 million. Their loan defaults have been going through the roof. And this is why I don't like Citigroup. Citigroup has too much exposure in the energy sector, especially in the energy production, um, oil exploration business. They have around 40% of the total loans. And the problem is, even if 5% of these companies default, Citigroup will more than likely go under at some point. I don't think Citigroup is going to go bankrupt because the economic state is quickly changing. But just remember, Citigroup is down around 60% from year to date, and the 5 year chart doesn't look too pretty either. Citigroup was actually $500 a share in 0506, and it crashed all the way to $2. I believe that Citigroup's assets are really over leveraged for its um, for how much assets they hold. And that's why I would never touch Citigroup. Now let's talk about a stock which I dislike even more. The last bank on this list is Wells Fargo. So Wells Fargo, not surprisingly, missed their earnings. They had expected of 45 cents per share. Actuality was 42 cents per share. They had an expected around 18 billion in revenue, and they slightly beat with 18.8. Uh, I was looking through the filings of how they reported their earnings. Again, I was not surprised on how poorly this company is doing. It's down around 60% from year to date. Why I will never buy Wells Fargo? That's a very interesting question. Many people say, "Oh, it's the most brought down stock." Wells Fargo is near its 52-week lows, while other stocks like Goldman Sachs are nearing its year-to-date highs. So my thesis behind Wells Fargo is that the main three things. One, they have one of the most poorest management teams of any financial institution I've ever seen. I feel like they're just in it for the money. They pay themselves too much. They don't pay their employees too much. And they're just a poorly run company in general. Two, they pay a lot of fines. They don't follow regulations. I believe if they strengthen their regulations and things that they do, it'll be much better for the company, which comes under management, I suppose. Three is that they've over leveraged their assets like Citigroup, but at least Wells Fargo is not in the energy sector. But they have provided loans for very questionable companies in terms of bankruptcy choice that they might go bankrupt, might not. So instead of playing it safe, they double down on their more high yielding, lucrative loans, I suppose. But bankruptcy will from these companies will affect these credit losses. As you see, they've reported $800 million credit loss for this quarter already, while JP Morgan required a net profit for credit losses this quarter. Another thing to note is that Wells Fargo has been not liked by many people. They've had so many sanctions and from 2015, such as opening, bank accounts for customers without them asking, sky high credit card loan interest rates and stuff of that. So they're very ticky tacky. And overall, I don't think the Wells Fargo stock will recover anywhere close to what it did pre-COVID levels, at least in the next 5 years, with interest rates so low. So in total, what I think about this sector is that I'm overall bearish. To be honest, I'm more into those online transactioning systems like Square, Fast Five Payments, and stuff like that. More growing streams. However, I'm bullish on one bank, which is only JP Morgan. I'm okay with Goldman Sachs and Morgan Stanley, but I believe their uses will keep on going down as retail investors take the new way of how people invest. And the reason why I'm bullish on JP Morgan is just I believe in the future there'll only be 2 to 3 banks alive, and I believe JP Morgan will capture most of that market share. There you have it, folks. I am invested in JP Morgan. I'm not looking to add to any of these positions. I hope you enjoyed this video and have a good day.
Not these